Barry, we've talked a lot about the big macro picture, the outlook. It seems like it's going to be quite difficult. And as I was mentioning in the previous segment, that I think we're probably at a point where people want to preserve and want to make sure that they're preserving their capital, preserving their cash. What do you think are some of the key takeaways that you're thinking about in terms of how you want to invest, and also looking for opportunities?
Yeah, when I'm looking at an environment where I expect very high volatility, you generally will have a defensive bet to your portfolio. But that doesn't mean that there isn't opportunities. And I think one of them right now, we're in the high yield bond market where reasonable quality companies are yielding over 9%. That's one of the few places you can get a real return over that. And I think you have to be careful because I do expect that double dip recession next year. But over the next 6 months, if you're invested in something that's yielding 9%, that's a 4 to 5% return over 6 months, and then reassess next year. That seems reasonable to me. I think the equity market I don't know if it's going to rebound much, but I don't think there's a lot of downside for this year, for the rest of this year, to the stock market. And there's a lot of high quality tech companies that are great businesses that don't have leverage on their balance sheet, that their stocks are down 50, 60, 70%. I think some of those companies are worth thing, but you have to stay liquid. And I think looking farther out, there's going to be a fair amount of distressed debt opportunities. It's not this year. It may not even be next year. But if I'm right on the double dip recession next year, later next year and into 2024, there's going to be some pretty amazing distressed debt opportunities.
Okay, so it sounds like be nimble, be tactical, and just understand that this is the environment that we're in. And it's not like the environment we've been in the past 10 years where the Fed had your back and all you had to do was really go long the equity markets. It's almost like we're back to, I don't know if we're back to, but the old way of investing. You actually had to really put pen to paper and do your homework.
Yeah, it's more of a trading market than a secular rise. And I think most investors are uncomfortable with that. They equate trading with risk. And to some degree, they're right, because in a trading market, it's going to be more volatile. And when it's down, you have to buy it. But when it rebounds, you have to sell it. So that's not something that a lot of investors are comfortable with.
Absolutely, and that is your area of expertise. I only have about a minute left. Barry, tell us the funds you're managing these days.
We're managing 3 ETFs for Horizons. The Tactical Absolute Return Fund, the ticker is HARB. That is, a really good vehicle for trading markets. And the other 2 are a high yield bond fund, HYI, and HSL is a high yield loan fund. To do that. And I think the high yield bond fund and the tactical bond fund are both quite well suited for the market we're likely to have the next 6 to 12 months.
Okay. All right. Great to know, and great to get your views as always. I know a lot of Canadian viewers know you, know your name. And so great to be able to catch up with you. Thanks so much, Barry, for joining us.
Yeah, it's great to do this again with you, Catherine. Thank you.
Thank you.